All right, this is the LBO transaction for VNU NV by Michael Glasson, Dan Kennard, Stephen Campbell, Jason Clark, and Ben Tesh. Nielsen Holdings, formerly VNU, is the world's #1 market research firm. They have a presence in over 100 countries and are the lead supplier of marketing information through its Nielsen Consumer Division, media information and TV ratings through Nielsen Media Research, online intelligence from Nielsen Online, and mobile measurement through its Nielsen Mobile branch. Some of its premier clientele include Coca-Cola, NBC Universal, Nestle, Procter & Gamble, and Unilever. Nielsen Holdings has a long history of aggressive acquisitions of publishing and research firms. VNU, or United Dutch Publishers, the firm that would eventually become Nielsen Holdings, began with the convergence of two Catholic publishing groups in 1964. This created the newest publishing giant in the Netherlands with prominent publishing segments in newspaper, consumer magazines, and book publishing. The company continued to aggressively acquire publishing companies throughout the 60s and 70s. By 1988, the company was the #1 regional newspaper publisher in the Netherlands and continued to increase its presence throughout Europe and the United States with its newly acquired Database and Business Information Services division. The next year, as the company continued to grow, VNU entered the television arena with larger stakes in Belgian and Dutch TV. In the 90s, the company made the decision to focus most of its efforts on its publishing operations and increasing states in the United States. With the purchase of U.S.-based companies SRDS and BPI Communications, VNU secured a strong stake in the North American business information market, as well as increasing its list of U.S. trade periodical titles. Nielsen Holdings started its beginnings when VNU acquired Nielsen Media Research in 1999 and AC Nielsen Corporation in 2001. VNU combined the Nielsen properties with other research data collection units, including Bases, Claritas, HCI, and Spectra. In 2006, a group of private investors operating under the name Valcon Acquisitions purchased and restructured the company for $11.4 billion and appointed David Calhoun, formerly of General Electric, CEO of VNU, which was renamed the Nielsen Company in 2007. In 2011, the renamed Nielsen Holdings NV had the biggest private equity-backed U.S. IPO since 2006 after raising $2.1 billion trading on the New York Stock Exchange. Currently, Nielsen Holdings is the largest global marketing and advertising research company, headquartered in New York City. They are followed by Kantar Group, founded in 1993 as the Market Research, Insight, and Consultancy division of WPP plc, a London-based public company. Third is IMH Health, an international company founded in 1954 that supplies the pharmaceutical industry with sales data and consulting services with headquarters in Norwalk, Connecticut. Following IMS is GfK AG, another international research company, established in 1934 as the Society for Consumer Research in Germany, and fifth on the list is Ipsos, a global marketing research company headquartered in Paris, France, founded in 1975, specializing in a wide variety of media, technology, and social relations research. Next, we'll have Dan with a description of the LBO transaction.
Nielsen Holdings was acquired by Valcon Acquisitions BV, which is comprised of 6 private equity firms: KKR, Thomas H. Lee Partners, Blackstone Group, Carlyle Group, Hellman & Friedman, and AlpInvest Partners. Valcon first entered into a bridge loan to make a tender offer to buy any and all outstanding 7.6% notes due. The bridge loan was later replaced by both senior secured credit facilities and by debt securities, with a total value of about $11.4 billion. Specifically, Valcon's tender offer to buy all outstanding 7.6% notes due included a consent payment offer of $40 for each $1,000 in principal amounts for notes tendered on or before the consent date. This offer was backed by the Valcon bridge loan of $6.164 billion. The acquisition was then completed through a permanent financing replacement of the bridge loan, which included senior secured credit facilities made up of 7-year $4.175 billion US dollar and 600 million euro senior secured term loan securities, and also debt securities made up of 650 million US dollar 10% and 150 million euro 9% senior notes due 2014. Also 1.07 billion US dollar 12.5% senior subordinated discount notes due 2016, and 343 million euro 11.125% senior discount notes due 2016.
As stated earlier, this LBO transaction was performed by Valcon Acquisitions, which was made up of a group of 6 different investors. They were Colbert Kravis Roberts, Thomas H. Lee Partners, the Blackstone Group, Carlyle Group, Hellman and Friedman, and Alpinvest Partners. Colbert, Kravis, and Roberts is an LBO specialty investment firm who have completed over $400 billion worth of transactions. They were also a pioneer in the LBO industry, and their investments focus on chemicals, the health industry, energy, and media. Thomas H. Lee Partners was founded in 1974 and have since raised $22 billion. Their target investments typically include financial services, consumer and healthcare services, and media services. The Blackstone Group is an asset management firm with a private equity arm that focuses on restructuring and reorganizations, and they have raised $13.5 billion. The Carlyle Group is an asset management firm specializing in private equity. They currently have $150 billion worth of assets under management. Their target industries are aerospace, automotive, energy, healthcare, and media. Hellman and Friedman is a private equity firm that focuses and specializes in LBOs. They currently report $25 billion of committed capital, and they target media, financial services, and information services. Alpinvest Partners is a private equity firm based in Europe. They currently have 42 billion euros under management, and they focus on LBOs. The rationale behind this LBO from the point of the firm and management was that this all-cash offer would provide the shareholders with an attractive, fair price. From the perspective of the investors, this restructuring that took place with the LBO would reduce costs by up to 10%. It also allowed VNU to remain and go forward as a single integrated company. Their ultimate goal was to combine product innovation, research, and development marketing into a single entity, and that they would begin performing as a unified global client service organization.
My name is Jason Clark, and I am going to talk about the tax consequences and accounting effects of the LBO. First, the tax consequences. There were no major tax consequences due to the LBO. The old notes were exchanged for new notes. Because of this exchange, there were no realized gains or losses due to the transaction. Now about the accounting effects due to the LBO. Cash decreased by more than half over the following 2 years. This is mainly because the cash was being used more efficiently and being invested into research and more profitable investments. Goodwill is the difference between the book value and the price paid for an asset. The goodwill increased because of the price paid for an asset of the company was over the book value. The most significant increase to assets was other intangibles. This increase was due to trade names, trademarks, and intellectual properties that were created through the LBO. Assets overall increased by almost 50%. Liabilities had a large increase as well. This increase was mainly due to the long-term debt that the company was taking on to use for research and other investments. Total equity remained fairly stable throughout the LBO process. Now Ben is going to talk to us about the financial ratios.
After adding a significant amount of debt to its balance sheet, Nielsen Holding began the deleveraging process by paying down debt and by increasing its margins. Since the purchase in May of 2006 until the first quarter of 2011, Nielsen had a reduced overall debt by nearly $1 billion while doubling EBITDA. Every year, Nielsen Holding was able to reduce the leverage ratio and has a stated goal of an additional 0.5 reduction per year going forward. The Nielsen Holding exit strategy began in January of 2011 by offering an IPO. Each member of the Nielsen consortium sold 20% of its position in the company. A total of $2.1 billion was raised. Over the next 2 months, money raised from the IPO was used to retire 5 debts with values between $107 million to $1 billion. The leverage ratio was then reduced from 5.8 times to 4.6 times. The IPO share price of $23 provided an internal rate of return of 7.6% from the initial share price of $16.23. However, only 4 months after the IPO and 5 years from the initial acquisition date, the stock had climbed over $8 per share to $31.03.
This represented a 13.7% internal rate of return. Since the IPO date, the stock value has increased approximately 25%. By comparison, the S&P 500 is down approximately 8% for the same time period.